Evening, everyone. Thank you for taking your time off on the beautiful Friday to join me in this webinar where I will be sharing with you some anecdotes which I hope that you will find helpful regarding income taxation in Malaysia. Basically, the topic that I would like to share with you is entitled Essential Principles of Malaysia Income Tax. Okay, the first principle of this is basically the source of income. If you look at any, the master tax guide, the first sentence in the master tax guide will say that income tax in Malaysia is territorial in nature. What this means is that income tax in Malaysia will only be chargeable for income that is derived in Malaysia. That is the general rule. Okay, where the source of derivation of income is outside of Malaysia, okay, no liability will arise even if such foreign income is later on remitted into Malaysia. All right? I'm saying that this is a general rule that will apply to most of the businesses in Malaysia, with the exception of certain industries, such as the airline industry, the seafaring industry, the banking industry, and the insurance industry. Those industries are basically covered under the worldwide basis, meaning that it doesn't matter where the basis of the source of the income of those companies involved in those industries are concerned, their worldwide income of those Malaysian entities will be chargeable to tax. Okay, the concept of territorialness of Malaysian income is very relevant in this case study that I'm going to share with you, which involves the taxation of employment income that is foreign sourced. And what happens is that some years ago, I've represented a senior executive of a technology management consulting firm, an international consulting firm with various affiliate companies in Malaysia, in Singapore, in the US, and everywhere in the world. So the issue involves the employment income of the senior executive employed by the company in Malaysia. So the contract employment of this employee and requires him to be seconded to work. So that was what had happened to him from the year 1999 until the year 2007. 8 years, he was fully working with the Singapore affiliates, although his contract of employment was signed with the Malaysian company. So he was traveling between Malaysia and Singapore throughout those 8 years. We tabulated that about 60% of his time was spent in Malaysia, while 40% of his time was spent in Singapore. But all this time he was working for the benefit of the Singapore affiliates that he had been seconded to. So with regards to income tax, the company had allocated his income tax this way. So for work that he did for the Singapore affiliates in Singapore, they had treated that as foreign source income and paid income tax in Singapore. And for those work that he actually did for the Singapore affiliates in Malaysia, they have treated it as Malaysian source and paid tax on that income in Malaysia. And in respect of his total income, which is subject to both Malaysian and Singapore tax, they have apportioned it in accordance with the number of days he is in the respective countries, namely 60-40 in this scenario. So far so good. But then in year 2009, the income tax did a tax audit on the company, taking issues with the income earned by what they call the outbound assignees of this company, asserting that the income portion that have been treated as foreign sourced, but all these overseas assignees are actually Malaysian sourced and subject to Malaysian tax. You can imagine that over the period of 8 years for this one particular employee, just one, the IRB is basically taking issue that throughout these 8 years, this employee had underdeclared his income tax. There was a severe repercussion of a risk of this being only a test case, in which event if the IRB succeeds, then the same treatment will be applied throughout the whole organization of this Malaysian company for all its overseas assignees. So in this example, so we can see that this the territorial nature of the that imposes the employment income to Malaysian tax can be a very important issue that needs to be treated very seriously and carefully by organizations. The matter was, at the end of the day, settled with the IRB. Right? Of course, I'm not able to share with you the terms of the settlement, but from this particular case study, we can appreciate a few salient principles. Okay, the first principle is this: and so employment income can be deemed to be derived in Malaysia under two circumstances. It will be a deeming provisions. It shall be deemed derived from Malaysia if the employment is exercised in Malaysia. If the employment is exercised in Malaysia, or if the employee performs outside Malaysia duties incidental to the exercise of employment in Malaysia, then it shall also be deemed as Malaysian source income. All right? So then the second principle is this: the place where the employee exercises employment should be distinguished from the source of his employment. What does this mean? For example, if an employee has a place of employment and the contract of employment is actually signed with a Singapore company, but this Singapore company sends this employee to actually physically work in Malaysia and derive and generate income in Malaysia, what will happen is that the exercise of the employment of this Singapore employee is actually considered as Malaysian source and subject to tax in Malaysia. And vice versa will be true. For example, in our the case that I've handled, you see, although the employee's contract of employment is with the Malaysian company, but because he actually physically worked in Singapore and derived income in Singapore, so the argument was that the work that he did in Singapore was actually foreign sourced. So that is a distinction that can be made. And the third salient issue, point is this: that of course the issue of whether the executive's performance of his duties in Singapore ought to be considered incidental to the exercise of employment in Malaysia is a matter dependable on the facts of the case. So, for example, in that particular dispute, whether the employee, who was a secondment, performed any work for the Malaysian employer would be a relevant issue. Whether the Malaysian employer played any managerial, supervisory, or employer role in respect of the employees who have been seconded to Singapore throughout those 8 years will be another issue of relevance. What type of benefit did the Malaysian company derive by having seconded its employees to Singapore for 8 years will be another issue of fact that will be relevant to be considered. So these are, at the end of the day, these are very factual, and there will be things that, these are factors that have to be considered. And it was the relevant consideration in respect of this particular case study that we did. And the fourth and final takeaway from this case that we did is this: how would you be able to reorganize the company's arrangement in order to reduce the risk of foreign source income being taxed in Malaysia, or arguably being taxed? Because one of the manner that could be considered is that the employee enter into a formal employment agreement with the Singapore affiliate company. And by doing so, he would then disassociate himself more clearly with the Malaysian company during the period that he was actually in secondment. So instead of being on secondment, well, they could have entered into the employment with the Singapore company, and when he was required to come back to Malaysia, he could have terminate his employment and join back the Malaysian company as a former employee. So that is the takeaway from the case study, that the first case study that